Good afternoon, everybody. I hope you had a good lunch. Welcome to ODI and congratulations to you all. Obviously, clearly either live close by or are cyclists or walkers or otherwise not dependent on the tube system. So congratulations on making it in today. And for those who weren't able to attend in person, welcome to the online audience. I don't know how many people we have watching online, but generally it's you can rely on the fact that you're speaking to about twice as many people as you think you are, at least thanks to the technology that we have here and the online audience. So welcome to you as well. I hope you'll be able to follow the conversation this afternoon. And of course, as ever, we are also live on Twitter. You can tweet using hashtag ODI Social Protection or ODI's Twitter at ODIDev. So I think that's all the communications welcomes that I have to do. As you know, we have a panel seated in front of you who will be the first panel of the afternoon. And we're talking particularly about the distributional impact of taxes and transfers. And then after the coffee break, we'll have a second panel who will be talking about taxation and social protection financing. I think also, I want to particularly congratulate Francesca and her team for putting on this event. I think that possibly social protection and tax are two of the most fashionable topics in the development sector at the moment. So I don't know if this was by accident or by design, but there's certainly, we're bringing together two of the things about which there is potential, there is some of the biggest kind of interest and enthusiasm within the development sector. The idea of the various different instruments that fall under the social protection banner, cash transfers and many other things as, critical instruments in ending poverty and achieving social change and justice, I think is something which, people like yourselves have been working on these issues for many years, but for a lot of people this is still a relatively new idea. And similarly, taxation, as a critical development issue, as well as an issue of sort of domestic policy concern in every country, I think, again, is something which is kind of obvious in retrospect, but in terms of the sort of mainstream development discussion is something, again, which is relatively new. So I think bringing together these two issues is a really kind of important and exciting thing to be doing. Now, of course, as those of you who have been working on these issues know, for many years and are expert in these things know, suddenly something which you know a great deal about suddenly becoming fashionable is something of a mixed blessing, because people come in with the idea that these things are very much simpler and more straightforward than you know them to be. And of course the work of all of you and the work of ODI's social protection programme in many years shows that the political, the financial implications of actually trying to run a social protection programme financed out of a taxation system is an incredibly complex and context-specific thing to be doing. We saw only yesterday in the presentation of the most recent budget of our own UK government how even in very well-established systems these things are constantly being changed and tweaked, and the political debate and contestation never ends, even in a system which is as well established as that here in the UK. So these things are incredibly difficult, and part of our role as academics is always to say, no, it's more complicated than that. But I think, it is still a fantastic thing that both of these issues, social protection and tax, and the link, and critically, of course, today, the link between the two are so much in the public arena, is a huge opportunity, and one that, it's absolutely essential that we use and bring to bear all of the fantastic research and sort of practical experience that is in this room to bear to make the most of this opportunity and this moment when people are looking for answers. And we do have the sort of political attention that will allow this experience and this knowledge to actually have an influence in the shaping of current and future systems of social protection and social protection financing. Of course, that's got a particular resonance this year as we start to debate the implementation of the new Sustainable Development Goals. And, you know, number one in the current Millennium Development Goals and almost certainly the future Sustainable Development Goals will be an aspiration to end income poverty. And I think one of the shifts from the Millennium Development Goals to the Sustainable Development Goals is a recognition, both in the architecture of the goals themselves and in the debates around implementation, of the role of social protection and of domestic financing, not just aid, in achieving that core aspiration. So I think this is very timely. Congratulations to all of you who are involved. I'm afraid I can't stay for the whole session, but I hope you have a really fantastic and interesting afternoon, and I very much look forward to hearing all about it. So over to you, to the chair of this first session, Simon Whitfield. Thank you.
Thank you. Do I need to do anything to turn on the microphones? Are they all on? Great, thank you. Thanks very much, Claire. You've done an excellent job of introducing the session, which gives me a perfect excuse to say as little as possible, because I think I'm by far the least interesting person before you on the panel here. I'm Simon Whitfield. I lead on tax and public financial management policy in DFID. With me today are three excellent speakers. Very much looking forward to hearing from them all. The format of the session is we'll have about 20 minutes each for presentations. What I will ask you to do is hang on to your questions, and at the end, so we've got about 90 minutes for the whole thing, so that should take us through to about the hour mark, leaving us good time for questions. We'll also be getting questions through on the Twitter feed, which I will try and remember to weave in. So without further ado, we'll move on to the first speaker, Nora Lustig. Nora is the Samuel Z. Stone Professor of Latin American Economics and Director of the Commitment to Equity Institute at Tulane University. Anybody who knows this area knows Nora's work. So I will hand over and say thank you very much.
Thank you very much, Simon, Claire, Francesca, for inviting me to be here today. It's a pleasure to come and have the opportunity to talk about our work at the Commitment to Equity project, which is now turning into an institute. And I just wanted to give you a little bit outline of what I'm going to be doing today. I don't think I'm going to go through everything because there are many slides, but I did it on purpose. The slides are here to be used as a resource, even if I don't have the time to go over them in detail. Let me just tell you a little bit of what the CEQ is, which is the Commitment to Equity project that, as I said, is now turning into an institute. It's a joint initiative of several organizations, and we try to sort of produce evidence to foster evidence-based policy discussion on fiscal redistribution. This is our website. If you go there, you're going to see a map with the countries that are being analyzed. The green ones are the ones that are finished. The orange ones are in progress. We've covered now in different stages 34 countries. And if you look at the countries, they include the biggest ones. So it's about 2/3 of the world population that we're actually being able to do these commitment to equity assessments. We have a handbook and various tools that can be used so that this exercise can be replicated. And the institute that we're currently launching is going to also actually implement also a database, an interactive database also, so people can do policy simulations, advisor and training services, bridges to policy, and obviously research-based policy tools, which is what we do more. I just want to give you three messages on the methodology. I have to do this even though I know everybody wants to see results. But I think, given what you said, Claire, I think it's very important to maybe clarify certain things that in the literature have been a bit confusing and repeated over and over again about taxes and transfers, their impact on inequality and poverty, and how one should study them. And they're very basic things. And they apply to any type of fiscal incidence analysis. You can have behavioral, computable, general equilibrium, intertemporal, or the pedestrian ones that we do, which are mainly the accounting framework at this point. These ideas apply to anything, okay? So we want to know whether the net fiscal system decreases inequality, decreases poverty, and whether distribution of the use of public services is pro-poor. So the first question is, what is a net fiscal system? And you see that different studies look at it differently. Some of them finish the fiscal system in what we call disposable income. So for market income, net direct taxes. Others say, okay, but I want to know what happens when you introduce the effect of indirect taxes and indirect subsidies. So it's from market to what we call now consumable income. We have borrowed that term from the Canadians. I like it because it tells you how much people can actually consume. In the OECD, now they've come up with the extended disposable income concept, which is the disposable income plus the valuation of transfers in kind. And then, you have perhaps the whole enchilada, to borrow a Mexican term, where you have the direct and indirect taxes, direct transfers, net, indirect subsidies, plus evaluation of in-kind services. We try to do the latter. We have not become universally comprehensive, but we are constantly including more and more dimensions, fiscal components of fiscal policy. And I want you to remember these concepts. Market income is pre-fisc, disposable income is actually the direct taxes and transfers, consumable income is after the indirect, and final income is behind the head right there for me, is after the valuation of in-kind services. We do fiscal incidence analysis, which essentially is how to allocate taxes and transfers, all these kinds, to individuals to get the pre-fisc income and post-fisc in different stages. So there are three main messages I want to convey today. First, analyzing a tax without the spending side or vice versa is not really useful. It's not only because even though taxes can be unequalizing, transfers may more than compensate that, but there's something even more subtle and weird in a way. Taxes can be unequalizing by themselves, but when they interact with the transfer system, they can have an equalizing effect. I'm going to show you some examples of that. I cannot, you can look at the reason why. There's a toy example even that shows that is very helpful. Second message, analyzing the impact on inequality only can be misleading. Fiscal systems can be equalizing, but poverty increasing, okay? So here, I'm going to show you an example. This is Ethiopia, either with the national poverty line or the $1.25 poverty line. The headcount ratio of post-fiscal or consumable income is higher than the market income headcount ratio, yet the Gini is lower. And it's not the only case where we find this, okay? Third message, analyzing the impact on traditional poverty indicators can also be misleading. You can have a fiscal system that reduces poverty using any of your anonymous measures of poverty, yet a substantial portion of the poor may have been impoverished. One thing is the churning, the other thing is what happens before after. So we found that, this is what we're measuring when we say they can be impoverishing. The red areas are impoverishing of the poor or making poor the non-poor. So you can have the pink being bigger than the red, and so your poverty gap will fall, but you still have a bunch of people who were poor and who were made poorer. And I think that's a very important message to remember. We probably want fiscal systems to do the least of that. Maybe you cannot avoid it in full, but you want it to do the least. And in Ethiopia, for example, we find that about a quarter of the post-fiscal poor, when you include direct taxes only and direct transfers, were made poorer by the system. Even if you include the in-kind services, monetized one, about 9% of them were made poorer. So that's with the national poverty line and with the 125 poverty line. Okay. Brazil, which looks always very good in terms of reducing inequality, more than a third of the post-fiscal poor were impoverished by the fiscal system. And it's about 10% of what people who make about $1 something a day in purchasing power parity lose about 10% of their income. And we looked at who are those people. Are they not receiving transfers? They are receiving transfers, most of them. Bolsa Familia, 65%. They're spending more on vice goods, which are highly taxed. But in essence, in Brazil, what's happening is that the tax system not by design, by the way, by the accidents of institutional design in different levels of government, tax very heavily beans and rice. So the poor pay a lot in taxes, right? So here, you know, this is the three messages that I wanted to leave here, and now I'm going to show you some results for the analysis that we did for middle-income countries. These are middle-income countries by the classification of the World Bank, and the first thing we want to look at usually is, because the redistribution, the distributive power, and the power to reduce poverty depends on the size of the pie of the fiscal budget. So here we have, for the 7 countries that we're analyzing, and also for the OECD, what is the social spending as a proportion of GDP. And as you can see, Brazil has the highest. In fact, Brazil has a size of government that's equal to the OECD average. If you put the primary spending to GDP, that's what it is. You go from Brazil all the way to Indonesia, which is the smallest state. And it's, I guess the first thing to show is that they're very heterogeneous countries, in terms of what they do for. And later I'm going to show you some relationships between initial inequality and what they do, if it's positively or negatively correlated. I want you to think about that. What do you think? Then this is how they raise revenues. We know, in general, indirect taxes are a large portion of the revenues, but also non-tax revenues are important in some countries, as we can see for Mexico and Colombia in the cases that I'm showing here. Okay, so how much do these countries redistribute? And here I'm measuring the change in the Gini. The positive is a good here. It means the reduction in the Gini measured in percentage points. And I'm comparing with these 7 countries with the USA and the EU. Now you see that there are 2 bars, a blue bar and a gray bar, right, for each country. What these bars mean is, how do we treat contributory pensions? Contributory pensions of the social insurance system can be considered either deferred income, if it's in an actuarially fair system, or a transfer if it's mainly subsidized by the government. The reality in many countries is in between. We don't know exactly what that in between means, so we decided to present everything for the 2 extremes. We have an upper and a lower bound depending on how you treat pensions. Interestingly, when you do not treat pensions as transfers, in the case of the EU and especially the EU, the amount of redistribution is much smaller if you don't think that they're transfers, right? And if you include them as part of market income, pensions, the initial inequality is much lower, and so the redistribution is also much lower. For the developing countries, you have also, what's interesting to note is a mixed picture. It's not always true that with pensions as transfer, the reduction in inequality is higher. For example, in Peru, and I think it was in Mexico too, it is lower. So it's not always true that the impact of pensions will go in one direction. And we find that over and over. I'm showing you a subsample, but we find this heterogeneity over and over again, okay? Now, this is the redistributive impact from market to post-fiscal income. And we can see that the indirect taxes have an equalizing effect in some countries and equalizing in others. That's what's also interesting. Indirect taxes may be regressive or progressive when you look at them using the typical measures as a Kakwani index. However, they are equalizing sometimes and they're unequalizing sometimes. Again, it's heterogeneous, and if you don't do the empirical analysis, you're not going to know. More interestingly is the message that I said at the beginning, that a regressive tax, which the 2 that I have squared in red there, Chile and South Africa, the line at the bottom has the Kakwani indices. They're negative. So they're regressive vis-a-vis original income. But they have, in the case of Chile, an equalizing effect, because a positive here means it's equalizing. In the case of South Africa, it's equalizing but very small, so it's neutral. So here you have a situation in which It's called the Lambert conundrum because he's the one who discovered, he's somebody from the Great Britain, by the way. He found that many systems could have this peculiar characteristic in which a regressive tax by itself, if you took it out from the system, the reduction in inequality would be lower than if you put it in. So we found that in some countries empirically. That makes it very important to do the analysis of the whole system, because what you find individually may be completely overridden by when you look at the interaction, and it's a mathematical phenomenon. Again, it applies to any kind of measure in terms of the impact. All right, so then what about poverty? Because I said my second message was that poverty could be increasing, although inequality could be falling. So here I'm looking at the change in the headcount ratio from market to post-fiscal or consumable income, both with pensions as a transfer or pensions as part of market income. Interestingly, the first country, Brazil, shows that poverty, the headcount ratio in this case, after you included the taxes, direct, indirect, the indirect subsidies and the transfers, is higher when pensions are not treated as a transfer. But it's lower when they're treated as a transfer. So that's telling you, and then, in some countries we have, in Russia, for example, we have gone deeper to see what's behind it. That's telling you that there are people who are poor, but if they're not pensioners, they're not going to be protected. And you can actually go more deeply into finding out who are these groups that the safety net has left behind. In Russia, by the way, it seem to be families, married couples with one child, that are left behind by the safety net system. We also find that in the case of Colombia, the headcount ratio is higher after you include all the taxes and transfers, not the in-kind here. And that doesn't matter if the way you treat pensions. We also start looking at, what income level on average people become net payers into the system in cash terms, if you don't include the transfers in kind. Well, in the case of Brazil, again, Brazil is very interesting because it's one country that you may look at it from one angle and it looks fantastic, and then you look at it from another angle, leaving aside efficiency issues, which, that could take a long time to discuss. But even from the equity point of view, it doesn't look so good because people start being net payers into the system for what in Latin America is considered the moderately poor, in the 250 to 4 range, okay? And in Indonesia, which does very little in terms of redistribution, the point is that there's also very little asked from the people. So they don't get much, but they don't do much either in terms of what they have to contribute. Finally, let me tell you about what we find in terms of progressivity and pro-poorness in the education and health spending. And here, I'm going to, forgive me for this, you can look at it in the quiet of your own time, but pro-poorness for us means that the per capita transfer of the in-kind transfer decreases with income, the per capita, not as a share of income. So in which cases do we find that? Well, we find that in terms of education in general, for all countries except Indonesia, the spending is pro-poor in that sense, on average for all the education levels. It happens in preschool, in primary, in secondary for all except Indonesia. And in tertiary, what we find is that in all countries, except in Indonesia, it is progressive only in relative terms, meaning that it decreases as a proportion of people's income. In Indonesia, it is unequalizing. Health is pro-poor in some cases. In the first three, Brazil, Chile, Colombia, and South Africa, it is almost neutral in the case of Mexico, meaning that the average per capita spending is the same, and it is progressive in relative terms only in the case of Indonesia and Peru, only meaning that it declines as a share of income, what the spending on these groups is. So shall I stop here? Because if I go, no, let me show you these two graphs. Yeah, I'm not going to go into Ethiopia. If you want, I can go into Ethiopia in the Q&A, or leave it here and you can look at it. So, we started asking some of the questions that, I don't know how many of you are familiar with Peter Lindard's book, Growing Public, which is a wonderful book because it looks at the historical evolution of the welfare state. came out in 2006. And he found that there is, in the historical context, what he calls a Robin Hood paradox, because the more unequal, the less they spend. And we try to see whether can we find something similar in terms of here. First of all, this graph for this group, but I have it for many other data points, shows something that is in a way reassuring, is that the more people spend on social spending, then redistribution is higher. There's a positive correlation between this, right? The next one is, okay, do we find if there is a Robin Hood paradox? And no, we don't find a Robin Hood. So there is a Robin Hood now. And we find that also if we include poor countries. I've done it with samples of 17 countries. I mean, it's not. I'm not positing this as an econometrically robust result. It's an association, and the association seems to indicate that the more unequal, the more redistribution. So instead of a Robin Hood paradox, we have a Robin Hood. And let me show you the final one. And this is, we have the trend of initial inequality and final income inequality. And here you can see the underachievers and the overachievers and the ones who are achieving right on average. So the overachievers are the ones below the line, the red line, meaning that they redistribute more than what the trend would show, and the ones that are above redistribute less than what the trend would show. So Peru and Colombia are redistributing less than what they can, and South Africa, which, by the way, when you compare it with rich countries, is actually better than some of the rich countries. South Africa is still just right on target because it is also the most unequal country to begin with. So let me stop here and thank you.
Thank you. Excellent. A lot to think about there. And thank you also for keeping to time. We will move swiftly along now to Laura Abramovsky, who is a senior research economist at the Centre for Evaluation and Development Policies in our very own Institute for Fiscal Studies, who must be very busy the day after the budget.
My colleagues. That's why I'm here. About other countries. Thank you very much for inviting me and for organizing this super interesting event. I may take thanks a lot. So, because I didn't print my slides, I may go there, if you don't mind, so that do you mind? No. So I can follow. So, I come from IFS. I'm at the...
You need to stay close to the microphone.
Oh, okay. So I sit here. Is that okay? So, as Simon... Yeah. As Simon said, I work at the Institute for Fiscal Studies, and over the last 5 years, we have been working on developing countries at a range of different issues for the last 10 years or so. And over the last 5 years, we have started doing some work on fiscal policy in developing countries. And we are increasingly doing more. And today, what I'm going to talk to you about is how do we think about analyzing reforms to tax and transfer policies in developing countries, but drawing on what we do in the UK. So using the same method, not so simple, but simple methodology, and the type of data we use, and the type of models we use, and show you then how we apply that methodology to analyzing indirect tax reform in Mexico, and how we think about the distributional and the efficiency implications as well. So let me, this one. So this has been discussed already. There is the tax and transfers, and tax in particular became very, very important topic in the development agenda because of a variety of reasons, and ensure fiscal sustainability. There is an appetite to increase spending on social protection and public infrastructure that enhance not only redistribute, but also enhance growth. And also there is a feeling that there is a need to reduce the reliance on donor funding, right? So it's coming both ways. From the developed world, it's saying, okay, guys, we have been helping you a lot. We are also a bit in trouble. You have to start taking responsibility. And also, like, this responsibility and making developing countries taking more charge on their revenues, there is a belief that it has spillovers in terms of state capacity and their ability to provide potentially better infrastructure and better social protection services. So as we have been discussing, so these systems of social protection, they have to be, given the limitation of resources, they have to really be well targeted and try to achieve their distributional objectives as well. And so understanding how these efficiency and distributional effects of tax and transfers policies as a whole is quite important in developing countries. And there's not a lot that has been done. Nora has been working over 10 years as well, right?
2008.
Yeah, almost. On the distributional aspect and doing an amazing work on trying to provide very rigorous evidence on that. And what we do is to focus now more on reforms, but taking into account the whole system when thinking about the reforms and putting tax and transfers together. So as I just said, to do this, we use a lot of models and assumptions and data, but we really need to, it's an empirical question, right? Like how does a reform in VAT affects efficiency and the distribution, and how does it affects the poor people in the country? You have to go to data and really like do some empirical analysis to understand that. And so let me briefly go through what kinds of quantitative analyses are possible that we usually focus at the IFS, and they are quite well established in the economic research. So the basic model to look at this type of reforms is what is called a static non-behavioral microsimulation model. So basically it's a bit as a accounting exercise given what you observe in the data, in micro-level data. So you assume individuals and firms don't change their behavior if tax or transfers change. And just given what you observe, so say a household consumes 10% of the expenditure is on food, and then the price of food goes up because you put a higher tax on food, then given that share, how much they would pay given the increase in the price. So of course, like there are behavioral effects because poor people, when their relative prices changes, you may want to take that into account, and that could affect the distributional effects and the revenue effects. So you're putting up tax because you want to collect more revenue to potentially redistribute in a more efficient way, or to finance roads down the road that you think will make these people more productive to go and sell their food in the local market. So there are trade-offs the government has to do. And so at the moment, the basic one, abstract from that behavior, focus on that accounting exercise, looks at one period, so simulate a reform at a single moment in time, looking at data from 1 year. Household model is more common. There is possible to do firm models, but I think we haven't worked much on that at the IFS. And so, as I said, one of the examples is this short-run effect of a higher rate of VAT. So, how you can extend that basic model? So there are these dynamics models. So they simulate the impact of a reform over a collection of years. And so, for example, this is quite relevant to look at long-run effect of pension rule changes on how this like a change today will affect payments into the, for example, contributory pension system, and how that would affect your receipts and hence your income, and how that would affect income distribution when you retire. So for that type of analysis, like a model, accounting model, but that stitches together years of data over time and simulates what would happen under certain assumptions, like for an individual that is 50 today, he's going to retire when he's 65. Today they're changing their rule, and so this will affect, given what you observe today, how this person will contribute to the pension and how much he will be able or she will be able to retire later. So we can do that. And I think that's quite relevant, particularly for this type of pensions and what Nora was saying. The behavioral, already I explained what type of, like you can use these models and incorporate the effect of changes in behavior. So people will consume less food if the prices go up because of a tax, and then how this affects the incidence of the tax and the revenue collection. And then what you can also do is to integrate this microsimulation model to a general equilibrium model that captures a more aggregate effect on the economy. We don't do that at IFS at all, but it can be done, but then you lose a bit of the detail of the analysis at the different sections of the population. So you will do it more to get an idea of what's going on at the aggregate. Let me check the time. Okay, there are, of course, a lot of challenges to do this, but there are ways of overcoming it, and you can do like increasingly more in the UK and also in developing countries. So there are measurement issues, lack of micro-level data or very poor quality, although this has been improving a lot in the last 10 years. And this is enabling a lot of this type of analysis that we do in the UK, and it informs a lot the policy debate and policy reforms in the UK. I think there is an increasing potential to be doing this type of analysis in developing countries because this increase in data availability and the collection of this type of data. The other type of data that is quite important is the access to administrative data of tax records or social security contributions. And so this, for example, even in developed countries is quite tricky. In the UK, it's not that obvious whether you can access that, whether you can put together, okay, this individual paid this tax and contribute to a social security. Can we put the two together and see how the two link and affect the behavior of individual over time? In Denmark, that's totally available to researchers. You can do amazing stuff. You observe people since they are born until they die, and the whole thing like they do, and how they interact with the state. But like I think this is also improving in developing countries, and there is like this. The governments are increasingly with caution, trying to consider the possibility of trying to share this data with researchers. Income and spending offer is underreported in household surveys, and there are ways to amend that to some extent. And some phenomena are very difficult to measure, for example, informality, because well, I will not go into detail because of time. And then the other thing that we don't know a lot is about these behavioral responses to changes in taxes and transfers in middle-income countries and developing countries more general, so I should have changed that, middle-income countries. I think we know less in low-income countries than in middle-income, but still in middle-income countries we don't know much, and this could be labor supply behavior, consumption, how firms react to changes in, for example, indirect tax, whether they, tax goes up and I pass it through completely to consumers, or do I absorb a bit because of the conditions of demand and supply and the elasticities and how consumers and firms react to competition. So there is a lot there that could be explored, or how does saving respond to tax treatment. So how do we assess distributional impacts at IFS? And it's well known, it's not IFS specific. It's like there are different ways of doing it, and the way we do it is, in terms of ranking, we discuss, shall we use income or expenditure to rank households as rich or poor? So there are issues with both of them, and we think it's worthwhile looking at both expenditure and income. So in particular, expenditure, one can think if there are if you think there is, they could measure better long-run living standards. If individuals have income shocks that they could somehow smooth over the life cycle. So to some extent, that's better, but we think it's good to look at both of them. And then to look at, in terms of looking at proportionality, so shall we use income or expenditure to assess proportional gains and losses? And this has been discussed a lot in the literature as well. And we have concluded, and the way we do it is to look at direct taxes. When we look at direct taxes, we look at as a share of income, because that's the tax base that is affecting. And when we look at indirect taxes, we look at expenditure. And then when you analyze reforms to both taxes at the same time, and then try to assess the distributional impact, you can do it on both and look at the change over using both denominators. Okay, so the other thing is we use relative measures and absolute measures to assess if a reform is progressive or regressive. So we take the, say, households, we rank them in terms of income, and we have the poorer and the richest households, and then we look at the gains or losses as a share of expenditure or income for each decile. And we also look at absolute measures. So, okay, how the payments, net payments, or gains or losses in absolute terms change over the income or expenditure distribution, and who is paying more. And so this is quite a relevant issue that I will talk in when talking about the example in Mexico. So we think like this is how we present when we analyze the budget in the UK. We do this type of analysis, and it's quite easy to understand, and it's quite it's a very good tool to communicate these findings to a wider audience and to have more impact with policymakers. 5, okay. There are more sophisticated measures. So Nora talked a bit about the order and the importance of considering the system as a whole. So I'm going to talk to you very, very, very briefly about a reform we analyzed in Mexico in 2010. But I think it has a lot of relevance for other developing countries and how we think about tax and transfers together. So, okay, so Mexico needed to raise more taxes, and the executive proposed a reform that was the VAT structure in Mexico has exemptions on food and certain other commodities, basically based on distributional grounds, right? Because the poor consume a higher proportion of their income on this type of commodities. So the executives say, okay, we have a better way of redistributing using more targeted instruments, because we have cash transfers, conditional cash transfers, we have transfers to the old called pensions. And so let's levy a 2%, in addition to the VAT that was 15% at the time, let's levy a 2% expenditure on all commodities and use that money to expand our more targeted social protection instruments. However, this was considered very regressive because of the reasons I will show you the graphs, but because the poor consume more in proportional terms of food, they will bear a higher burden, the losses would be higher for them. And so the approved reform by the Congress was a reduced version of this. They increased their revenue, but by less, by increasing the 1 percentage point the VAT rate and keeping exactly the same structure. So, okay, can we say something about whether this was a good idea in terms of achieving that goal of redistributing with the system they have and the instruments they have at hand? So what we did was to build a microsimulator for Mexico using Mexican data, taking the tax and transfer system of Mexico, coding it in this microsimulator. The simulator can do a bunch of stuff. Again, like you can have these slides and more. I have like some reports that you can have if you are interested in more details. And so what we did was to use that model and that data to simulate the distributional, calculate the distributional effects of this anti-poverty expenditure tax, so the expenditure that was going to finance. So yes, if you look, so the red bars, so you have like the axis, the x-axis are the income distribution, so you have 10 deciles along the income distribution. On the y-axis, you have gain loss from the introduction from this 2%. And so when you, and this is as a share of income, the red, and as a share of expenditure. So first of all, if you look at proportional losses, if you look at as a share of income, it is regressive, right? This 2%, this 2% tax was regressive. So poor households lost more as a proportion of income. But when you look at it as a share of expenditure, because it's a 2% for everyone, and so it's totally neutral, right? Mostly neutral. So that's the green bars, and that's less than, the incidence in less than 2. So you see like the losses are 1.2. They should be 2%, but that's related to the informality sector that we do measure. We have some proxies for informal purchases from vendors that we think are not in the VAT net. And so that's why you have less. And so, okay, we have that, but could the government have done better? What would they have if instead of implementing the approved reform, they implemented the other reform and use the difference to finance other social protection policies? So first of all, what we look at this is, okay, this amendment that made in proportional terms made the reform more progressive. So you see that here you have households across the income distribution. The blue bars are the gains from the amendments to the reform as a share of expenditure, and the gains are higher for the poorer households, poorer deciles. But when you look at who gain most in cash terms, this goes significantly to the richer households. So the green line that goes and is like on those axes, on the right-hand side axis. So that's the cash gains. How much on average households in each decile gain from the modification of the 2% to the just increasing the rate from 15 to 16. I will finish now. And so what you see is like there was a lot of cash that was not collected, and that basically the ones that gained the most from this revenue not collected were the richer households. So how could this foregone revenue have used to finance social protection and alleviate more the poor? So where you see, so the green bars here are the gain from the are the gains that were experienced in cash terms from the amendments. So that's the green bars, and it's as we see the increase, the richer you are, you gain the most. So if you use that to finance, for example, a flat rate transfer of 1,000 Mexican pesos that is flat across all, it's the same for all households, and that's the light blue bar. So you can see that in cash terms, so in absolute terms, is less regressive. So it would have improved the distribution of the impact of the reform. And then if you go a bit further, so and use the instruments that the Mexican government has, that could have been even much better in terms of redistribution, right? Like the gains in absolute terms that the poorer households, so the 1 to 3 deciles in terms of income, they could have gained significantly more in cash terms and hence in proportional terms as well. And so, like, even so, say you may think some countries don't have this type of social protection instruments because they don't have the state capacity, although a lot of this is changing, and that's why we are having this event today, because social protection systems in many low-income countries are developing. But okay, they are not developed yet. Governments potentially could try to use more effectively tools to redistribute that just exempting food from the VAT system. And so I want you to, yeah, that's it, I think. I could do more, but I think I stop here. Hope.
Okay, so we can come back in the
Yeah.
questions. Thank you very much. A lot more to think about again. Last speaker hasn't had to travel very far. Francesca Bastagli is Head of Social Protection at the ODI as well as Senior Visiting Fellow at the LSE. Over to you, Francesca.
Okay, I'm just wondering, yeah, I'll stay here. Could I
Have the-
Thank you. Okay, well, I'm going to take a bit of a step back and look a bit more at the broader picture, if I get the presentation on, and look at two things, really. Oop. How does this move? There we go. So what I wanted to do is, on the one hand, look at some of the underlying trends and patterns in tax revenue and social protection spending in lower and middle income countries. And then also discuss some of the country-specific contextual factors that tend to characterize some of the low and middle income countries that we're talking about here, and on which new work is being developed around distributional analysis. So considering the economic structure, labor market structure, and other administrative capacity considerations and so on that affect, of course, some of the results that we saw in the earlier presentations, but also have implications for policy design and the policy options around both social protection development and revenue, the objectives of raising revenue. Now, one way of identifying patterns or characteristics is through comparative analysis. Here we're looking at information on tax revenue by macro region as a percentage of GDP. Let me just say by way of caveat, these are of course very aggregate figures and need to be looked at with some caution, but they do provide an initial background indication of patterns that I think are worth flagging as we discuss the evolution of distributional analysis in low and middle income countries. In particular, a result that comes as no surprise to most of you, of course, tax revenue as a percentage of GDP in countries in sub-Saharan Africa, Asia and the Pacific, so in poorer countries are considerably lower than tax revenue levels in high-income countries. This means, of course, that governments to begin with have less revenue to work with and less revenue to spend. There are also variations in terms of composition. And in particular, what stands out is that in the so-called developing, so low middle-income countries, tend to rely more heavily on indirect consumption taxes. Again, we saw this earlier in the presentations. But this is an important pattern, and compared with high-income countries who rely more heavily on direct taxes and particularly on personal income tax. On the spending side, again, we see lower levels of spending as a percentage of GDP. This is in part reflects what we see on the revenue side, lower revenue levels, lower spending levels. But again, we also see variations in terms of composition. And in particular, social protection spending accounts for a much lower share of total social spending in lower income countries compared to high income countries, where the share of social spending that goes to social protection policy, so policy that explicitly pursues a poverty or redistributive function, is higher. Now, if we consider trends over time, again, the story changes slightly depending on the data set that you use, but both IMF data and this is data from the International Center for Tax and Development all show on average increases in tax revenue in developing countries over the course of between 1990 and 2010, or even if you take a longer time frame. However, these average increases remain somewhat muted, and we're still looking at much lower levels of revenue, of course, than higher income countries. If we look at sub-Saharan Africa alone, and we look at the variation or trends in the composition of non-resource revenue, what you see very clearly is between 1980 and 2010, a distinct and clear reduction in revenue from trade taxes, accompanied by an increase in revenue from consumption, so indirect taxes. So one of the factors that we find underlying the average increase in tax revenue in many low and middle income countries is precisely the expansion of consumption indirect taxes over time. And these are accompanied also by a, frankly, muted increase or comparatively stable revenue accruing from direct taxes in the form of personal and corporate income taxes. The second factor that underlies some of the average increases that we see in countries that do have recorded increases in average revenue from tax is the increased reliance on revenue from natural resources. So here, if we split the analysis, and in particular, if you focus on the right-hand side on lower middle-income countries, which is where the countries that tend to be that richer in terms of resources are classified, we see a starker increase in total revenue from tax between 1980 and 2010, which partly reflects, again, a marked increase in revenue from resource taxes, accompanied by a decrease in revenue from non-resource taxes, and we'll come back to that in a bit. If you look in comparison to low-income countries in sub-Saharan Africa, the much lower increase in total tax revenue is linked with an increase in non-resource tax, and in particular the expansion of indirect taxes, consumption taxes. So, again, in terms of these broad averages, and we need to be clear that country examples vary tremendously. So these averages, of course, hide huge variations. But in terms of these averages, we see that both the expansion of consumption taxes and increased revenue from consumption taxes, along with the increased revenue from natural resources, present huge opportunities. And one of the papers that we've just put out lists examples of the ways in which revenue generated through reforms associated with expanding consumption tax revenue and new revenue through natural resources has been employed to expand social spending, improve social protection programs and policies. However, these are also sources of revenue that are cause for concern, both from a distributional perspective and a sustainability perspective. Now, what perhaps didn't emerge very clearly in the previous presentations, but certainly does emerge from much of the existing literature and reviews of the incidence and distributional impact of consumption taxes, is that they tend to, on average, particularly if you use income as the variable along which the units of analysis, so individuals or households, are ranked, these tend to, on average, be, certainly for OECD countries, regressive. In proportional terms. No, exactly. Yeah. So, of course, in fact, this may vary once you factor... Yeah,
we can go into the methodological discussions. What you're doing when you use consumption, essentially you're taking disposable income.
Yeah.
And you're assuming that the contribution of indirect taxes happens only after people have already paid their direct tax, and that's okay. But that's essentially what you're doing, and it's in the sequence in the fiscal system. You assume that's your starting point. It's not that you rank by the end point. It's you redefine the starting point. Okay.
Yeah. So this is something that we will hopefully come back to. But essentially, so there are. The point is the fact that the consumption taxes make up such a large share of revenue in low and middle income countries means that we are particularly concerned with their distributional implications. On the natural resources end, there are concerns around sustainability. So the fact that the revenues from natural resources are associated with high fluctuations, associated with volatility in commodity prices, means that there are concerns around the sustainability of financing social protection policies from using revenue from this source. Another concern associated with revenue from natural resources concerns the diversification of revenues, and there's increasing evidence that countries that are resource rich and rely heavily on revenue from natural resources tend to invest less or have less developed non-resource taxes. And indeed, we did see that in passing, looking at the average trends for sub-Saharan Africa. Beyond this, there are, of course, revenue gaps, and we don't have time to go into this in detail now, but I do want to flag, if we are talking about taxation and its links to social protection, that low and middle income countries are characterized by a range of revenue gaps, including under-taxation of land and property, under-taxation of wealthy individuals, growing, increasing reliance on reduced tax rates and tax incentives with the objective of attracting investors, despite evidence showing that at best there's an unclear link between these tax incentives and increased investments. And associated with all of this, of course, high rates of evasion and tax avoidance, both by wealthy individuals, but also corporations, particularly transnational corporations that can rely on a range of practices to avoid or indeed evade tax. And there's a growing number of studies that quantifies, estimates the scale of revenue lost through these practices. Beyond moving away from tax revenue and towards spending, and I'm only talking about social protection spending right now, but of course health, education, other social spending sectors are absolutely critical. What we see in social protection, the area of social protection, is, as Claire mentioned at the outset, a growing interest in social protection as a tool in tackling poverty, tackling inequality, but also promoting progress towards achieving other development goals. And this is reflected in a growing number of countries adopting social protection type policies. If you take a quick look, even simply in terms of non-contributory social assistance or safety net programs, we see even in the last 5 or 6 years, rapidly growing numbers of countries adopting particularly cash transfers, unconditional, conditional, but also public work schemes. However, so despite expanding numbers of countries adopting these types of programs, the coverage of social protection continues to remain low in many low-income countries, and the levels or adequacy of the transfers also continues to remain low. And this is reflected when you use some of the basic incidence framework to analyze the effects of transfers. This low coverage and low levels of transfers are reflected in the low poverty and inequality impacts of social protection transfers in poorer regions, particularly in South Asia and Sub-Saharan Africa, which, by the way, are the regions where the highest number of global poor are residing. So, for instance, if you look at recent figures on coverage of non-contributory social assistance type programs, we are looking at very low coverage. If you look at the low-income countries on the left-hand side, the social protection program with the highest coverage, so school feeding, covers less than 10% of the bottom poorest quintile of the population. So low coverage, low levels of transfers limit the potential impact of these instruments. And finally, the other characteristic of such programs is they tend to be predominantly funded by externally, through aid or external assistance. And we'll get to this, I imagine, in the next session, but may touch upon this here, the implications of high reliance on external financing for social protection development, and in particular, as several people here also have written about, implications around country ownership, sustainability, and continuity. But what are the other factors that are specific to the economic structure, to labor market structures and countries more broadly, and that are particularly salient when we consider both distributional analysis but also the policy options available to low and middle income countries? Important factors that need to be taken into account concern informality. So high informality, you touched upon high informality and the challenges associated with taking it into account when designing distributional analysis. Informality not only has been high, but continues to remain high, and studies that are projecting, looking forward at trends, suggest that it will continue to be high. So a study by Filmer and Fox on youth employment in sub-Saharan Africa shows that looking forward, most of the jobs that will be created over the next 10 years, the vast majority will continue to remain informal. And this, of course, has implications around the options for raising revenue and social protection coverage. Interestingly, in many countries, efforts to tax the informal sector, or indeed to bring informal sector workers into social protection, formal social protection coverage, have historically been weak, perhaps because these are efforts that don't necessarily lead to short-term or immediate results. Having said it, there's huge potential to address this issue, but it is an issue that does matter, both in terms analytically and in terms of policy options. Low per capita incomes, again, can and do in practice restrict some of the options around raising revenue, and many have argued that the persistent low or moderate increases in per capita incomes limit the scope, for instance, for the development of direct personal income tax. Again, whether this is whether the case should be made to abandon or weaken efforts to develop progressive personal income tax systems, or indeed to instead try to strengthen them, is an issue I hope we can discuss during the discussion. Administrative capacity matters hugely. Weak capacity, again, can limit the scope for the implementation or adoption of particular design features. And I'm thinking, for instance, of what Laura just talked about around the VAT and the differentiated rates of VAT. The more complex by design they get, the higher the costs that might be associated with implementing these differentiations if capacity is weak. Again, so an issue that needs to be considered and tackled. And finally, slightly separate but linked, of course, the question of tax morale and willingness to pay. So in many low-income and low and middle-income countries, willingness to pay is low. This is a variable that in turn is affected. We know the literature, there's quite an extensive political economy literature showing how this phenomenon is linked to weak or ineffective or unfair tax systems. So the perception of an unfair tax system and its can lead precisely to this phenomenon, while stronger, effective systems that are associated with strengthening accountability mechanisms and better or improved public service provision in turn can be linked to improved tax morale, willingness to pay, and indeed revenue. So this is just some evidence around jobs, the new jobs being created in sub-Saharan Africa. So very briefly, what are the implications of these very sort of broad trends in terms of distributional analysis? On the one hand, I think what is interesting is that we know that there's quite extensive evidence, or in any case, evidence on the distributional impact of taxes and transfers is published more regularly for high-income countries. And often this analysis is focused on direct taxes and direct transfers, regular comparisons of the distribution between market and disposable income, as Laura pointed out at the beginning. In the case of high-income countries, this is still a limited approach. It's still missing out on large sectors of fiscal policy. But in some sense, the fact that it's capturing important shares of the system makes it perhaps more meaningful. It's absolutely crucial when extending this type of analysis to lower and middle income countries to include consumption taxes, in-kind transfers, but also corporate income taxes, those taxes that, as we saw in the original or initial aggregate graphs, are of particular importance in the case of developing countries. However, there are several reasons why, up until recently, and certainly up until some of the initiatives and efforts that have been undertaken by our colleagues here, why consumption taxes and in-kind spending are less frequently integrated into this type of analysis. This is also associated with the challenges of including these types of taxes and transfers in distributional analysis. So, for instance, the establishment of the incidence of direct taxes and direct transfers, but also their value, is much more straightforward than factoring in consumption taxes, in-kind transfers, where the type of assumptions that need to be made, but also, of course, the data requirements vary hugely. And as you said, of course, there are ways around this. We know there are different options, but certainly it is a less straightforward exercise, and these are issues that need to be further developed and tackled. From a broader perspective, so moving away from distributional analysis and considering policy, there are questions related to specific policy design. So given that consumption taxes, high reliance on natural resources are of particular importance in low and middle income countries, what are the policy options around, on the one hand, designing consumption taxes, and on the other hand, managing natural resources that will help to ensure that these both sources of revenue are indeed associated with, let's say, more progressive or fairer systems. And finally, just to conclude, given that there's general agreement and growing agreement around the fact that we do need to consider the distributional impact of the system as a whole, so of taxes and transfers considered jointly, what are the implications around this in terms of policy? Are we suggesting, for instance, that most of the redistribution should be pursued through social spending, which is what many experts suggest? They say at the end of the day, the incidence and whether or not a tax is equalizing is not that important, so long as the revenue generated is then used and channeled into social spending that is progressive. Is this what are we suggesting? As you alluded earlier, of course, lower income countries where social protection is weaker, there's less scope perhaps to use social protection in this function. And even if we were to decide that actually that's the way forward, is this really the case? If we want to establish stronger links between the two, from a purely policy perspective, so moving beyond the analytical one, how do we ensure that particular revenue is channeled on to particular sectors of spending? We can't, right? Is there a role for earmarking? Probably not. In practice, again, we see that in some countries where this has been achieved, some form of earmarking was used. On the other hand, we know, and we'll hopefully get the chance to discuss some of the severe limitations and concerns around earmarking. And finally, and this is again just to bring back into the picture the political economy dimension of all of this, which is often lost in our basic incidence analysis. And to go back to the question of tax morale and willingness to pay, if people's perceptions of the fairness of the system matter, right, and also probably of separate tax instruments and transfers, what implications does this have? And if it's true, as the political economy literature shows, that certain taxes, particularly direct taxes, are especially important in establishing and tightening these accountability mechanisms, these improved relations or state-citizen relations, what, again, implications does this have in our discussions around options for policy design?
Great. Thank you very much. Let's move swiftly along to the Q&A now. Thank you very much to the speakers. What I'm going to suggest, I presume we need a microphone for questions. Somebody's going to come around with a microphone. What I'll do is I'll take 3 or 4 at a time. So when you have a question, please say briefly who you are. Keep your questions short as well, please, because we're running a little bit short of time. And then if you want to refer it to a particular speaker or to the whole panel, then please say that as well. So we have three here in a cluster and one over there. So if we could perhaps take these three